Investing in stocks can be a lucrative way to build wealth over time, but choosing the right stocks is essential for maximizing profits and minimizing risks. Understanding the fundamentals of stock selection can empower investors to make informed decisions and achieve their financial goals. Firstly, conducting thorough research is crucial when selecting stocks. Investors should analyze the company's financial health, including revenue growth, profitability ratios, debt levels, and cash flow. Examining quarterly and annual reports, along with studying industry trends and competitive positioning, provides valuable insights into a company's potential for future growth and profitability. Assessing the management team and corporate governance practices is equally important. Strong leadership with a clear strategic vision and a track record of prudent decision-making can significantly impact a company's long-term success and stock performance. Investors should look for transparency, integrity, and alignment of interest between management and shareholders. Another key factor to consider is the valuation of the stock. Determining whether a stock is undervalued, fairly valued, or overvalued requires evaluating various valuation metrics, such as price-to-earnings, PAE ratio, price-to-book, PB ratio, and dividend yield compared to industry peers and historical averages. A disciplined approach to valuation helps investors avoid overpaying for stocks and enhances potential returns. Assessing the economic moat or competitive advantage of a company is crucial for sustainable profitability. Companies with strong competitive barriers, such as proprietary technology, brand recognition, or economies of scale, are better positioned to defend market share, generate consistent earnings, and deliver long-term shareholder value. Identifying and investing in businesses with durable competitive advantages can enhance the probability of achieving maximum profit. Considering the broader economic and market conditions is essential when selecting stocks. Economic indicators, interest rates, geopolitical factors, and sector-specific trends can influence stock prices and market sentiment. Investors should adopt a diversified portfolio strategy that balances risk and reward across different sectors and asset classes to mitigate volatility and capitalize on opportunities in various market environments. Diversification is a fundamental principle of risk management in stock investing. By spreading investments across multiple stocks, industries, and geographical regions, investors can reduce the impact of individual stock volatility on their overall portfolio performance. And continuously monitoring portfolio performance is essential for successful stock investing. Regularly reviewing financial news, company updates, and market trends allows investors to make timely adjustments to their investment strategy. Implementing stop-loss orders or trailing stops can help protect profits and minimize potential losses during market downturns or adverse. While short-term market fluctuations and volatility may occur, focusing on the underlying fundamentals of quality companies with strong growth prospects can lead to significant wealth accumulation over time. By adhering to a disciplined investment approach and staying committed to their financial objectives, investors can navigate market uncertainties and capitalize on opportunities for long-term prosperity. In conclusion, choosing the best stocks for maximum profit requires careful analysis, research, and consideration of various factors including financial health. By adopting a systematic approach to stock selection and staying disciplined in their investment strategy, investors can optimize their chances of achieving financial success and building wealth through stock market investing.